Great. Good morning. Good morning, everyone. Excited to be here today, joined by a star-studded panel. I think let's kick off with a few introductions. My name's Antimo. I head up new business and strategic partnerships at Westbrooke. We started life as a principal private equity investor focusing solely on South Africa. That was all the way back in 2004. Since 2011, we've been building out our alternative asset management business, very much as an emerging manager across South Africa, the UK, and the US. As an emerging manager, we've just crossed $1 billion of assets under management. We're unashamedly lower mid-market focused in these jurisdictions across our 4 key investment pillars, which is real estate credit, hybrid capital, direct lending, and private equity. Over to you.
Yeah, my name is Per. I'm from Wimmer Family Office. Our current focus is on real estate, like we just heard a minute ago, private equity, and we also are involved in the listed market. We trade European shares primarily, ETFs, and we allocate to hedge funds.
Excellent. Over to you, Alex.
Hi everyone, my name is Alex Seddon. I run impact and private equity at M&G. So M&G is a sort of 500 billion AUM savings and investment business headquartered here in London. Within my team, we manage about $15 billion across private equity, primary co-investments and secondaries, also infrastructure, private equity, funds, co-investments, secondaries, and then we also have recently built, well, over the last 6 years, built a direct impact growth equity strategy called M&G Catalyst. Nice to be here.
My name is Christiaan de Lint, and I work for Headway Capital. And at Headway Capital, we back what are called independent sponsors. So we co-invest with independent sponsors, also called fundless sponsors, private equity professional that work on a deal-by-deal basis, that work without committed funds. And we do that in Europe and in the US.
And I'm Mark Watts. I work at LCP. I'm a partner in the investment team. For those of you who don't know LCP, we follow an investment consultant model, so pretty much the same as Mercer or Cambridge Associates. Clients we advise have assets of just over $1 trillion. So since everybody's mentioning trillions today, I thought I'd add our trillion to the mix. If you're not doing $1 trillion, what are you doing? I guess what makes us quite different is, although we're 1,300 people, we have 130 people who focus on the energy transition. And the one thing we've observed is that when you're looking to invest in the energy transition, if you're an asset owner, it's a complex area. And with our 130 people, what we're doing is trying to demystify that particular area and offer advice to clients as to what sectors are ready and what aren't. And then to further help, we're bringing 2 fund of funds to the market to invest in either the private credit side or the infra PE side. And that's really global allocation to the energy transition.
Thanks. In advance, I thought I'd do a bit of a fun exercise with the panel, more to highlight, everyone in this room is looking to allocate capital to the highest point of return, but against a macro backdrop that is increasingly and ever more volatile as the year goes by. So I asked the chaps on stage to sort of, how would you describe the current macro using the title of a film? So I'm not sure if you saw that question, but if you'd open the batting for us.
Yeah, sure. I mean, one of the things we're particularly excited about, which has an impact both on energy as well as real estate, combining the two, is data centers and what all that entails, because we're going to need an awful lot of them, driven by AI, given all the money, the trillions that are, well, billions for sure, but it's getting up there to the trillions that are being raised. That drives, is driven by AI and the need for that, data centers, and then energy consumption that comes with that. That's a massive opportunity that we are quite excited about. To give you an idea, more specifically, by 2030, that category of data center is going to consume about 3% of all electricity in the world. So it's massive, and there's so much to be done ahead of us. And 3% is roughly the equivalent of Japan. So you're talking about a very significant amount of number. And you're going to need energy to do that, whether it's traditional oil and gas, or it's nuclear, or SMRs, or large-scale nuclear. You're going to need battery storage. You're going to need absolutely everything. So we're quite excited about that theme, and we think that's got very long duration.
And if you had to summarize that into a title of a film, what would you call it?
A title of
a film.
A title of a what? Film. Oh, film.
A movie.
A movie. The big, I don't know. What's it called? The one Al Gore did. The problem with energy he put out. I can't remember the title of it.
Good shot. Alex?
Well, I had two, actually. So one was Everything, Everywhere, All at Once, because I think that there's a huge amount going on in the macro. One of the interesting things about my job is we get to do a lot of stuff, across a lot of different sectors. And whilst there's a lot of volatility and macro uncertainty, there's never a shortage of opportunity. It can be a bit overwhelming at times, hence the name of the film. But if you keep calm, then there's plenty of things to look at, and incredibly exciting technological innovation as well. And so then my second film was Her.
Interesting.
Which is about an AI girlfriend. And I think we kind of got to the world of Her a little bit quicker than we all thought we would.
Christiaan?
Well, I was hoping not to be the last, because then you might pick up a movie that has been picked up already, but it didn't happen. Didn't happen. Maybe it will happen to you. I also have a few. Actually thought about a few. The first one was Oppenheimer, because like the race for AI and the race for technology, but then so much talk about AI that I said, well, I don't want to pick this one. Then I had the good, the bad, and the ugly. But then, probably have to explain who's good, who's bad, who's ugly, and I don't really want to go there either. And then, The Hangover, I'll pick that one. Just because it's like trying to make sense today of what's happening in the world, trying to figure out why and so on is just really, really difficult, quite entertaining as well. So I'll stick with that one.
But may I just comment? I think The Hangover is too early, to be honest. I do think we are still in the build-up phase of all these amazing things. But I do think there's going to come a time, maybe in 2 years' time, 3 years' time, I don't know, when we sit here, where The Hangover is going to be very appropriate, because there'll be a lot of lost investments. It's a bit like, you remember .com, when all these crazy money was running in, etc. It is different this time, because there's real earnings and there's a lot of real stuff happening, but there will be some big winners coming out of this, and there'll also be some lost capital. And that's where The Hangover, I think we're going to bring that one back to the fore.
What about you, Mark?
The joys of going last. At least I get a little bit longer to think. I'll come back to a sort of a socio-economical kind of comment at the end, but I think the answer to that is depends where you're sitting, depends what country you're sitting in. So I'll give a slightly naughty answer. If you're sitting in the US, then there's a couple of movies that spring to mind. One is Parasite, which I think... In fact, the other one's even worse than that. So maybe I'll just stick to Parasite. But I think Everything, Everywhere, All at Once is kind of interesting, because we, I think, as a society, are having to grapple with so many things. And I think there's the particular gentleman who coined the phrase in the 1920s, the culture lag. I think it was Ogden. And then a bit later, it was kind of re-quoted. And it's science's ability to acquire knowledge is faster than society's ability to acquire wisdom. And I think what we've got at this moment in time is an unprecedented amount of change. And I think for most people in most societies, they can't actually grasp that rate of change. We talked earlier on about the K-shaped recovery or growth. There are some winners and there are clearly some losers, and those losers, I think, are now falling toward populist parties. I think that's just a danger. I know we're talking about finance here really and not sort of geopolitical commentary per se, but I think as long-term investors we've got to be really, really careful where we're placing our bets, because that policy change aspect can actually take you out of some of your trades. And I think in energy transition, where we focus, just looking at that sort of policy risk, I think that's really come home to roost in the US. But as I'll explain hopefully a bit later, the story's not over there.
No, I think that was just a highlight against the background, which we're all trying to sort of make returns, which is always fascinating. So to dive into sort of more of the subject matter, and this is one for you, Christiaan, since you started Headway, sort of what has fundamentally changed in the private capital landscape? How are we witnessing? Is it a cyclical slowdown? Are we witnessing a structural reset?
There's been if you just take the recent past, there's been quite a few trends that everybody kind of knows about. There's a strong slowdown in distribution in private equity, and that has had quite a few impact on different aspects. There's been the returns also. They're not what they used to be either. It's a different environment. It's harder to get return, which also led to a number of impact. And I think the industry has been quite good at reinventing itself, at finding ways to address it. I think the secondaries market is evolving because of the lack of liquidity, giving rise to the GP-led. The lack of liquidity has really pushed the evergreen, semi-liquid part of the private equity also to come back. The lack of returns or people looking for alpha elsewhere has pushed sort of the deal-by-deal model to like strong growth for the past couple of years as well. And I think we'll continue to see that. Now, I think the previous panel raised a few things like alignment and things. There are question marks with the traditional fund model. The K-shape is something that we start talking about a lot. It's very polarized. Some people raise the capital and it all goes there, and most people won't. So there's going to be, I think, quite a big shake-up in the private equity sector. Many people just won't be able to raise additional funds, which will again give rise to the next set of evolution, more deal by deal, I think, and less funds. So is there a fundamental something broken? No. Is there a definite evolution? Yes. I think things will continue to move. You'll always see innovation in that space. And if you look at it from the beginning to like 25 years ago to today, it's quite different, but it's a slow evolution that I guess we'll continue to see.
I suppose following from that, Alex, how are LPs' expectations evolving around liquidity and DPI governance and transparency? Where is that shift?
Yeah, so I'll say a couple of things. The first thing to say is the asset class is absolutely huge now, right? I think it's like $8 trillion in total. And like you say, unless you're talking in trillions, you're not talking anymore. So it's a big asset class, and it's a maturing asset class. So I think one of the things that we're seeing in terms of the increase in secondary liquidity, I think it's like 250 billion or something, the volumes per annum now. That's just a maturity of that asset class, right? As more and more capital has flowed into that asset class, people want liquidity. So I think that's an important point, right? It's understandable that we're seeing the growth in the secondary market, given how big the primary asset class has got. I think the other thing to say is sort of rise of co-investments. Again, it's kind of inevitable that people will want to develop their investment capability, and rather than just being a passive primary fund investor, they want to come in alongside the GP. They want to reduce their fee basis. They're becoming more sophisticated in terms of their capability. That's certainly the path that we've taken within our firm. Much more emphasis on co-investments, much more emphasis on secondary, because you can drive more returns. So I think that's the point I would make about where the market is, and that's kind of normal that it's maturing. A couple of other things to say, though, is rates are not as low as they were from the financial crisis to 2022. And we don't expect those kind of conditions to return. And as a result of that, managers have to drive performance through operating improvements and excellence. And so we expect that trend to continue. The final point I would make is we're in an unprecedented place in terms of how much value creation is happening in the private markets versus the public markets. We're all very much aware that we're about to have $3 trillion companies coming to the public markets. Anthropic was only worth, 4 or 5 billion a couple of years ago now. So, people are complaining about returns, but if you were in Anthropic 2 years ago, you're not complaining about returns, right? So you've got to look where the value is being created. And the value is being created in technology. Interestingly enough, the value is happening a lot in hard tech as well, rather than kind of traditional software. So like, as I said earlier with my film title, I think it's easy to get stuck in a particular channel and start complaining about the returns. Put your head up and have a look. There's plenty going on, right? There's plenty of other places you can get returns if you're in the right markets and the right companies.
And potentially one for you, Per. So would you, off the back of that, say that the traditional fund model is under pressure of being absolutely reinvented?
Yeah, I would say there's evolution taking place as opposed to disruption, like overnight disruption. I very much agree with what my fellow panelists have said. You have, on one hand, an enormous amount of capital being deployed into a very concentrated set of bets, particularly on the private side, but now also on the public side. I mean, you're going to see the biggest IPO of all times this month happening. I mean, that's very significant. 50 billion or 75 billion, whatever they're looking to raise at 1.75 trillion valuations. I mean, these are numbers that, 10 years ago we would never even think about pronouncing like that. So we're going through historic times, and that has implications. It's been interesting to see also how the lead up to this has been playing out, because you've had all these secondary transactions going on, whether it's SpaceX, whether it's OpenAI, Anthropic, or Revolut for that matter. And there's a whole sort of cowboy land of God knows what intermediaries, and everybody's got access to this and access to that, and there's a whole football team involved, and they all seem to be best friends with the one sitting with the allocations. So there's been all that kind of craziness going on in the lead up to this. Now, obviously, some of these companies will be floated, so it's going to be a lot more predictable what happens. Once they are floated, you're going to see some other interesting dynamics happening, which are also a bit unusual. The first thing you're going to see is SpaceX, for instance, which is only putting out 5% of it out to proper float, which is very little. And yet, they've changed the index rules to make them much shorter for index conclusion. So you're going to see a lot more squeeze in the market and arguably keeping the share price artificially high because of that change of the rules. That's a new thing. So there's a lot of new things happening, and that has implications. It's not something that happened overnight. It's something that's been on an evolution step by step. But this also has implications for how fund managers would set up, GPs would structure themselves. Like I said, this whole secondary market has been massive, both on direct and single transactions, as well as fund secondaries. Case in point being the likes of Coller Capital, which got bought by EQT recently. Well, there's a reason why EQT bought Coller. Well, it's a good business. Jeremy has built up a fantastic business. But it's also, there's a lot of growth and opportunity, just like you were saying. There's potential for excess returns. So these are the things we see in the market at the moment.
Thanks, Per. I think one for you, Mark, just going back to sort of the energy transition and how the panelists before have articulated on real assets and infra. What are your concerns around any overcrowding in these sectors?
Yeah, if we stick to energy transition, I guess, and don't stray into data centers, I think that would make life a little bit easier. Data centers do pop up in the energy transition world and in conversations, but they tend to be restricted to not the real estate aspect, but just how they're powered. So that whole solar co-located battery type argument, that's where we start seeing it in portfolios. So because we take a fund-of-funds approach, we also are very keen on taking a whole-of-system approach. So I think in conferences like this, you tend to see people over-focus on infrastructure, and therefore renewables. So renewables is one part of the picture, how you produce energy. But also we're seeing some great opportunities in, you mentioned storage, how you store that excess energy. Quite often you need to move that energy around the system. So the network and grid investment side we find highly fascinating as well and very investable. And then the other often overlooked area is the demand side of the energy transition. And so that's the decarbonisation of transport, the decarbonisation of heat and cooling, and also the decarbonisation of industry. And we're seeing a ton of investments in those areas. So when you look at it through the lens of what is overcrowded, these areas are not overcrowded at all. And when you look at maybe the strength of flow more recently, even in renewables, has been quite strong. But look at the move to 2050. We're going to need so much more investment in renewables out to that period. So for me, we're in the foothills. So yes, there may be some short-term congestion, but actually over the next 10 years, 20 years, there's going to be a lot more opportunities out there. So we're seeing returns on the infra PE side of about 15% IRRs, net of underlying manager fees. And on the private credit side, we're also seeing around 10% net of manager fees. So for us, that we think is an attractive proposition.
And Alex, your take on that, just given your impact focus, great to get your views.
Yeah, no, I agree with that. And just a couple of other points I would add. I mean, we see this from our direct growth equity portfolio in particular. I think there's an interesting interplay between the huge amount of capital that's going to build next generation compute and energy transition. And why is that? Well, if you think about this huge amount of capex that's coming out of the hyperscalers, it's like 800 billion, I think, per annum now. They've all figured out that they've got a couple of different pinch points. One's energy, one is clearly compute itself, chips and memory, but energy is a really big deal. And so what we're seeing, particularly in the US and elsewhere, is significant investment in in a number of areas that are around the energy transition, whether that's grid resilience, whether that's long duration battery storage, or whether it's, more interestingly, people don't often think about this when they think about impact, but if you can invest in technology that improves the efficiency of compute in any way, that is very, very impactful, right? So that could be algorithmic efficiency, that could be the way you cool data centers, that could be any of the above. And so we're really seeing, despite the hostility of the Trump administration towards sustainability as a term and impact as a term, we're still seeing huge amounts of investment in energy transition technologies in the US, driven by this absolute demand for energy that's driven by the AI capex boom. So I'm generally an optimistic kind of character. I think these are two of the most interesting thematics that are going on at the moment in terms of building out next-gen compute and also decarbonizing industry. And there's some really interesting interplays between the two. And there's trillions of dollars of institutional capital required to get us to where we need to be. And the economic incentives are huge because of the transformational effects of these technologies when they're applied to real-world solutions, whether that's healthcare innovation, whether that's material science, all of the above, right? So I think that doesn't feel like it's slowing down anytime soon, and I think that throws up tons of opportunities for impact investment, despite the slightly negative sort of political winds that we've suffered since the second Trump administration.
Do you mind if I just jump back in on that? Because I mentioned, obviously, the Parasite book earlier on. I've just remembered the other book I should have mentioned, which is, film, which is Idiocracy. Because I think both of those apply, actually, over here in the UK as well, if anybody's looked at our politics for the last sort of 5 to 10 years. I think that point is a really important point, because you can see what's happening at the federal level in the US, But you scratch beneath the surface at the state level and what's going on with hyperscalers, it's a very different story. One of the reddest states, Texas, is one of the biggest users of renewables. Another purple state, Iowa, putting in renewables like there's no tomorrow. Why? It's simply cheaper and quicker. So in this race for power that we're going to be having for the next couple of decades, be you a corporate or a state, you want solutions that are easy to implement and cost effective. And if you look at the levelized costs of solar and wind, it is far, far easier to do that than it is to put in gas power stations and gas turbines. So for instance, gas turbines, 5, 6, 7-year backlogs in some countries on those gas turbines, whereas solar, 2 to 3 years and you're up and running.
Christiaan, to go back to you, why do you think LPs are increasingly prioritizing co-investments and direct exposure?
I think people have hinted to quite a few things now and before. I think you mentioned fees, economics, so that's the first easy element to prioritize co-investments. Direct exposure is seen in a lot of different ways. Some people see co-investment as direct exposure, some want to make real direct investment, so it really depends a little bit what you're looking at here. I think it's also just try to get better returns. I think personally I'm usually a little bit skeptical about co-investment or traditional co-investment alongside funds because as an LP you'll see them because they're bigger, not because they're better deals. So I'm not sure like you can really outperform or even get like better deals. I think the academics around that is mixed. Some people say yes you can, some others say you can't. I don't know. But I think that's pushing people to see it more. And I think every GP raising money now has to promise a lot of co-investments to its LPs just to get the capital. And you know, like it's like many things, you promise whatever people want to hear, and then you figure out later if you can do it or not. But that's again a slightly different discussion. I think there's also this idea for many LPs, and it depends on what type of LPs. If you go more to the family offices part, who wants to be closer to the assets, more direct decision taking. And some type of co-investment or direct investment or working on a deal by deal with independent sponsors has that element of being much closer to the asset. And I think people like that as well. And I think in that element, you also have probably more scope for outperformance versus large fund commitments to the mega buyout firms. So yeah, these are various elements of answer why people want to see that. But it's clearly a very big trend and it's a very big topic now in the LPGP community.
And in that light, how are investors approaching valuation discipline in the current environment, GP-leds versus secondaries versus directs, in the underwriting framework, and how do LPs look at that? Alex, you want to have a go?
Yeah, I've just got a couple of points that might be helpful there. I mean, I think this is a really important point, one. So the way we're handling it is we basically brought our direct growth equity capability together with our private equity fund, co-investment, and secondary capability. And we did that because we wanted to have a very high quality direct investment approach to doing co-investments, right? Because the point you hinted at, I think, is a very real one, right? There's a adverse selection risk here. One, because the deals are bigger, but also because, you know, maybe some of the better, clearly if a GP gives you a bad deal, it damages the relationship. But I think, you know, oftentimes, maybe a business needs more capital. There is a sort of adverse selection in the whole way in which these deals arise. So if you're not looking for that, and if you're not applying a direct underwriting rigor to it, I think you can get to disappointing returns. So the way I think about this, I mean, I've sort of come from a direct investment background, but I think the type of investment professionals that you need looking at these portfolios has changed quite dramatically in the last 10 years, right? There's a big difference between an investment professional who allocates simply to primary funds as an LP versus the kind of investor that you need to drive value in today's market. And what I mean by that, you need people who are transactional investors who can manage complex secondary transactions. You know, someone's running. We recently did a 1 billion managed secondary sale of our portfolio to CVC. Now, the person you have running that is very different to the person you would have allocating LP capital in a more passive way, right? So it requires a different skill set, much more sophisticated transactional investment skill set. And you have to apply the same underwriting rigor to your co-investments as to your direct investments, and then you'll be okay. So my simple point is, yes, the market is moving in this direction. Yes, I think it will continue to move in this direction. Our own portfolio is 75% primary. We're going to move that to 50, and I'm sure we're not alone in that sort of desire. So the market's going to continue moving in this direction. But it does mean that you need to have sufficient scale and capability to be able to execute effectively. Otherwise, you're just not going to get the returns that you hope for.
And Christiaan, back to you. Can we talk about the rise of the independent sponsor? And
how much time do you have?
As quick as you can. It would be great to get your views on that.
Well, I think there's a rationale for this market to grow very strongly right now. There's a push within the fund world. I think someone said earlier, like carry comes late, incentives. Here you have the ability as a sponsor, private equity sponsor, to be much closer to assets, to get a better economic environment, to go back to the origins of private equity, where you work with companies trying to add value. So I think there's a push away from fund for private equity professionals and a drive towards this model. And same on the LP side, you have this view of being closer to asset, taking deal-by-deal decisions and everything that people like, and you can have the potential for much better returns. And Julian Loki has come from some data on the space. And if you look at US and Europe, it was 6 billion of transaction volume in 2019, grew to 31 billion in 23 to 65 billion last year. That's just in a few years. You said 250 billion for secondaries. It took the secondaries market until 2019 to pass the 100 billion mark. So we have something here that just grew so quickly over the past few years that it just cannot be ignored today anymore. And from an area where nobody talked about like just 18 months ago, today it's like getting very quickly a big thing, but for good reasons. It's needed, it's there, it's growing, and it's something that's here to stay. The last point, just on the there to stay, it's very interesting because there was a bit of a stigma with independent sponsors previously. Oh, you can't raise a fund, you try to do deal by deal. And what we see now is that people say, oh, well, I'm going to create a track record independently in the view of raising a fund later. So they leave a big private equity firm, they do 1, 2, 3 deals. And when it works, if you ask them again, well, you wanted to raise a fund, you still want to raise a fund, the vast majority of teams now say, actually, no, I don't want to have a fund. Why should I? only have negative sides of having big funds. So you're seeing now a world where some of the best private equity teams just don't want to have funds anymore.
To add to that, I heard quite a crude but interesting take on that deal-by-deal economics are hard drugs to get off.
Absolutely. There was, at our AGM, we had one of the independent sponsors talk, and one of the our LPs asked, do you want to raise a fund? And he started laughing, and he said, if we're our team, we start raising fund, half our teams walk through the door the next day. So yes, absolutely.
Fascinating. I think let's go back to you, Mark. Just in the build-up to this, you said you spent a long time living in the region in Abu Dhabi. Just to get your take on, where the GCC is fitting within the broader global capital sort of realignment and the reset, especially what's been going on in the region in the last 6 to 8 months.
Absolutely. So just to expand on that a little bit, I lived and worked in Abu Dhabi for 4 years, so it was 2010 to 14, ran National Bank of Abu Dhabi's asset management business. And before that, I set up an Islamic asset management business for the Qataris. And after both of those, I ended up running a PIF-owned bank in London. So I've got a sort of an interesting perspective, having lived and worked for a few states. I mean, I've seen over that last 20 years a phenomenal change in both the scale, size, sophistication, and also the human capital locally. So when I was over there 20 years ago, there was a big drive in the UAE for what they termed Emiratization, which is basically quota-driven employing locals. If I go back now, then you can see the fruits in pretty much every single country in the region, where you've got a ton of CFA charter holders, locals, rather than expats coming in and doing those roles. Female participation has gone through the roof. Lots of incredibly dedicated and hardworking individuals in that area. Now, I think it's true to say, and I think we had some numbers this morning from Imtiaz of sort of 6 trillion of assets at the sovereign or quasi-sovereign level. It is reality that 60 to 70% of that money in private markets does flow overseas. so primarily into UK and Europe. But if you take the one minus of that, then 30 to 40% is actually starting to stay at home. So you have seen lots of international asset managers and some domestic asset managers now really spreading their wings locally. Lots of fund domiciliations in DIFC and ADGM. So you can see that ecosystem growing. So when you align that with things like the Vision 2030 in the Kingdom and the various programs you have in other nation states, then I think you've got the makings for an increase, I think, year on year for the next decade at least. And so the recent issues we've had in the Middle East, for me, only will cause people to double down on that trade. There's going to be a lot of inward investment that's needed by the states, a little bit of rebuilding, but also that recognition that we need to do stuff locally. We can't keep relying on international providers of either capital or goods. So I think what's happened in the last couple of years is just going to, I guess, put a shot in the arm once things calm down of investing locally. And I see that there's a lot of human capital in the region that's actually poised to take advantage of that now.
Amazing.
So I'm a bit bullish.
Amazing. I see no reason not to be. And Alex, I think in the build-up, we also touched on sort of, the fact of traditionally or historically the outflows from the region. If things are staying more in country, capital formation staying local, capital will inevitably always have some sort of flight. Can you touch on the differentiation of managers and the importance of the niche in which you play to attract that capital from the region?
Yeah, I mean, a couple of observations would be, I think capital is still very much flowing out of the region into overseas managers based on our recent interactions and evidence. I think there's clearly has been historically a significant allocation to the larger US managers, and I think across multiple asset classes those allocations have been made and are pretty much full up. What we've observed is very much a desire to partner in a more sophisticated way than just being an LP. So oftentimes leading with co-investments. So the way we think about it, say on the direct growth side, partnering with allocators and investors in the region on specific deals that are of interest to them. So bringing them into a co-investment upfront in a particular sector or a thematic that is directly of interest is a very good way of building a relationship. And the other point, which is kind of obvious, is you need to spend a lot of time building those relationships. I'm talking, 3, 5, 10 years rather than 3, 5, 10 months. So you need to be committed, you need to be open, and you need to be willing to build genuine partnerships over the very long run. And I would say the allocators in the region are probably the most sophisticated in terms of wanting those very broad and deep relationships, rather than being a passive LP. So that's one thing that we've observed. I think the other thing would be, oftentimes we're thinking about scaling our businesses internationally. So, maybe we have a long duration battery storage business that starts in the US, but the whole point of our fund is to help these businesses scale internationally. And oftentimes the region is a great place to build, the second or the third sort of manufacturing plant or sort of, building that kind of operational scale requires economies that have significant amount of private capital, but also very much aligned governments that are able to, ensure that the right regulations are in place. So we very much see Abu Dhabi and other countries in the Middle East, Saudi, and as being very good places for our portfolio companies to build operational scale. And we have a number of examples where that happens. And going back to this point about partnership, that is all part of, the sort of expected way in which I think European managers need to engage with the region if they're going to get any sort of any traction.
And Per, with your family office hat on, Do you have any particular views to add to that?
Yeah, I mean, I very much agree with what's been said here in terms of trends. Certainly when it comes to sort of direct versus funds, that trend we see very much in the family office space, just a preference of being hands-on involved or at least close to the action as opposed to blind pool. And part of this, so you have these, that's a preference that sort of runs separately in the family office world, in addition to what has been told earlier, these trends of concentration, with the top 10 funds taking up a lot of the available capital and everybody else having to fight. And therefore, we end up with these deal-by-deal situations often, which may well be here to stay as a trend. So we very much see that. In terms of the Middle East, we spent quite a bit of time down there, and there's huge opportunities. Yes, there's a bit of geopolitics going on at the moment, but eventually that will calm down. And then it's, I bet you that the governments are going to throw a lot of money at it, getting back up again. There will be a beautiful marketing campaign, but it'll be backed up by real sovereign money as co-investments, and that will again attract foreign capital coming in. So I do see the region as having a very bright future after this very unfortunate geopolitical situation that's going on at the moment. So we're very long-term bullish on the region. We're certainly planning on spending a lot more time on the ground once things settle down. We do see opportunities. We are building up relationships, which, like Alex is saying, is very important. So we are doing as much as we can within the confines of logistics at the moment. So we see great opportunities there. And we're very bullish on that outlook.
I suppose I wanted to actually try to open up a bit of Q&A to the floor. So try to sort of move to a last hot take question for the panel. In the context of everything that we've discussed, what is the biggest blind spot to investors in the context of what we've discussed? Per, you want to kick us off?
What do you mean by blind spot?
Sort of the most underestimated sort of risk, or what we're missing in the context of secondaries, co-investments, GP-led directs.
I mean, there's always a risk of I mean, look at people like Buffett and his massive cash pile. You know, for slightly more traditional investors, there's always this risk of hype taking up a lot of room. I do think we're in the early part of the whole technology boom and investment, so it's probably too early to talk about it, but at some point there's going to be a bit of, you need to think carefully about where the chips are being placed, no pun intended. I mean, the chips are actually a very good sector at the moment, as we've seen with the various trillion-dollar companies emerging. So I do think we're in the growth phase. I do think it's different to .com in a sense that there are real earnings driving this. This is real cash flow. You have even the Max 7 and their deployment, a lot of that is out of organic cash flow to a very large degree, maybe minus Oracle, because Larry, he's piling up on you know, he's adding a lot of debt into the equation. I was actually together with his family office just last week, and we were talking about it, but they seem very confident in it, and they just okay with that. But that's potentially a risk, because if that bet goes wrong, I mean, my God, he's levered. And at some point there will be things that fall out of bed. But for now, we're in the build-up phase. It's exciting. It's supported by real earnings. But we do have some macro clouds out there we should not be unaware of. And what are those? Well, for starters, you have the geopolitical situation, which does have real implications. You know, energy prices high. That pushes inflation up. Look at the bond market. Look what's going on there. You got higher bond yields, and probably higher bond yields for longer. So the bond market is flashing up a little bit. And equity investors, please take note. Often you see the bond market being the leading indicator to what goes on. But what is the saving grace for now is real earnings, because real earnings are coming through. And if it wasn't for that, I tell you, we would be in a much more subdued conversation here. But for now, that's bailing us out. But watch the bond market, watch inflation, watch the flashpoints and those implications that comes out of that in terms of energy prices, raw material. And there's also even if things were to stop tomorrow and everything went back to normal in the Strait of Hormuz, you have the follow-on effect, which will still come through. You still have all these fertilizers that got stuck for months and months and months on end. Well, that means that the poor agricultural farmer in Africa and elsewhere are going to see higher prices. For now, they have problems with supply, but it's higher prices eventually, which will feed into food prices, etc. So you do have a delayed effect, even if things sorted themselves out tomorrow. So also be aware of that. That's another bias, be aware.
And Alex, any other blind spots?
I was going to say pretty much the same thing, but I'll just build on this point. I think what's interesting and what makes it difficult to invest at the moment is we have the inflationary forces that I think you've just outlined very, very well. But set against that, you have the deflationary effect of AI adoption, right? So AI will lead to greater productivity. And if you look at the Western economies, a number of them are in a bit of a similar bind, right? I mean, we talked a lot about the US. It's very easy. I could talk about the US all day, but if you look at the UK, right, similarly, challenges in the bond markets, right, and challenges in terms of like inflation and cost of living and all these difficult things. But the more optimistic case is that the UK and Europe has extremely high quality IP in technology and healthcare and all of the areas that matter in the future. And Western economies don't really have any other choice than to innovate their way out of this mess, right? And the US government is clearly signaling that's the approach. They're going to keep running the economy as hot as they can, despite inflation. Rates will come down, but it's going to take a bit longer than we'd have all hoped if it hadn't been for the war. But they have no other choice other than to double down on AI and hope that the productivity gains come through. And that helps drive the economy and drive inflation down. So K-shape can be applied to a whole bunch of different things, but it's absolutely happening. If you look at the cost of public services, healthcare, you look at kind of university costs, you look at food costs, all going up. You look at the cost of technologies collapsing and will continue to collapse. Look at the cost of entrepreneurship, collapsed. Right, you, as a single entrepreneur now, you can build what would normally have taken 20 engineers and a pre-seed round. You can just do it at home now with Claude. And you can also, by the way, connect your business to public blockchain networks, which are free, and you can raise capital, you can make payments, and you can run all your business on the cloud. So that's pretty cool, right? So when you look at the technology side of the equation, costs are collapsing. That's going to drive productivity. That's deflationary. But then when you look at the other side of the equation, undoubtedly we have real inflationary forces in the world, and the war in Iran has exacerbated that. So this is where we are. And even in that complex world, there's huge opportunity, right? And one of the biggest, most successful trades of the last 12 months has just been looking at where the physical pinch points are to this build out of modern compute, and people made a lot of money on memory, and the fact that SpaceX is valued at 1.7 trillion is very much about that, right? Why is it valued that? Not because of the earnings, but because they have a complete and utter monopoly on space launch, right? And space launch is fundamental to technological progress for humanity. So, and they have a huge amount of compute that they've built, which was obviously quite a smart thing to do. So anyway, look for the physical pinch points. I think everyone can feel where we're going. And you just have to be very selective about how you invest in this complex environment.
Your blind spot?
I'll just probably leave it as if people go to a conference and there's a lot of panels and everybody says something, and if it's all the same, just go in the other direction. I'll leave it at that.
Mark, anything to add?
I'm going to confuse things then. I've been short and caught, I think, and I'm talking about my PA book rather than anything I do in my day job. They're very different things. I actually thought the wheels would fall off the US equity market way quicker than they actually haven't at all right now, and I am worried. I just worry that these issues we've got in the global economy, the demand destruction we're seeing in Asia, the troubles that we're having actually in the global south, pretty much across Africa, in terms of price rises of diesel and petrol. I just think there's a lot of trouble being stored up. But what I am seeing, and I have been suckered back into the market, so I am now investing in the US again, PA. And what I'm looking for is, what is that thing that actually ends this miracle? When the tide goes out and everybody is actually in the US ends up being naked, what is that impetus? Because at the moment, with that faith and that hope, there is that perpetuation of that sort of the brave new world, the future economy. It's hard to bet against that, but when actually it all stops, I suspect people will sit there and go, what on earth were we thinking? The amount of leverage that's being built into the system, the amount of trading that the seven are doing amongst each other. There seems to be a sort of an element of Ponzi that I haven't got my head around yet. But while it's still going on and the trend is your friend, I think it's dangerous to be out of that market.
Amazing. I think fantastic insights, and I think we may have 2-3 more minutes, so I would love to open to the floor, make us a bit more. Oh, we don't. Okay, sorry. Okay, well, anyway, amazing. Thanks for the time, gents, and I hope everybody has a great rest of the conference today.